Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Monday the 16th of January. I'm Daniel Lam, your host for the podcast. I remember a few months ago, I was taking a ferry with my baby to one of the outlying islands in Hong Kong. It was an old ferry and it moved very slow. My baby was asking, "Are we there yet?" like 47 times during the ferry ride, pretty much once every minute. Well, for the last 12 months, many investors must have been asking, "Are we there yet?" to the Fed pausing its rate hikes. Let us try to shed some light by looking at some of the more recent macro data points on this. So first of all, the US CPI from last Thursday. The US core inflation slowed to 5.7% year-on-year in December, but on a monthly basis, it accelerated by 30 bips. Another key figure is the US service sector business confidence, ISM Services PMI. It plunged to just below 50 for the first time since the depth of the pandemic. Except for the post-pandemic plunge, the December Services PMI was the weakest since the GFC. Forward-looking new orders sub-indices have started contracting, following similar contraction seen in US manufacturing sector activity. So, although a slowdown in US average hourly earnings have raised hopes of a Fed pause, we believe such hopes are premature, given the still strong job creation numbers and renewed decline in jobless claims. In our view, the Fed needs to see a steady decline in the core inflation to below 20 bips increase month on month for a few months, to bring annual inflation towards the Fed's 2% target, and a consistent fall in job openings, and a steady rise in jobless claims in order to lower wage growth before the Fed pauses. So no, we are not there yet for the Fed to pause hikes. We continue to suggest investors to be fading this US equity rally. We are expecting the fourth quarter earnings on S&P 500 to fall by 2.2% year-on-year. This will mark the first earnings decline since the third quarter of 2020. S&P 500 index faces strong resistance at 4,100, followed by even stronger resistance at 4,300. For those seeking to add exposure to US risky assets, they could consider the less volatile US dollar high-yield bonds or alternative assets. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.